In this video, you will learn how you can raise a $30 account with boom and crash indices. And I'll be telling you how boom and crash work and what will help you to be able to raise your account progressively and fast and consistently. And you'll be also learning the trading strategy that we can use to perform this miracle. So I'll be teaching you a very strong trading strategy that which I've never taught before. And this one works exclusively on boom and crash. And I will also be teaching you the do's and the don'ts on boom and crash. I will be teaching you what you're supposed to do and what you should never do when trading boom and crash. Let's get to it. In order to trade a small account like $30 on your synthetic indices account, it is very easy for you to do that on boom and crash. And I'm going to be teaching you guys a trading strategy today that you can use this strategy to make money on boom and crash. This strategy is like a liquidity trading strategy, although it works like a support and resistance trading strategy, but there is a bit of liquidity in it that makes it work perfectly, and I'll be teaching you that. But before I go to that, I want to tell you how this boom and crash really work for those of you who are watching this video for the first time. So boom and crash is an asset on Deriv, and this asset is known for spikes, although this is a 15 minutes time frame. So if you're on the 15 minutes time frame, you won't see much of those spikes. But when you go down to, let's say, when you go down to 5 minutes, you understand you're going to see a lot of these spikes in the market. There will be a lot of spike here, and you will see them, a lot of spike, although you will see the market also moving in this selling position. But when you are trading boom and crash with the strategy that I'm about to teach you, you should only focus on the main trend of that asset. Like when you hear boom, you know that you are in an uptrend. Anything you want to do, you should focus on uptrend. And when you're trading crash, you know you're in a downtrend. You should only focus on the downtrend part of my strategy. Now, this is the 5 minutes, and if you go to the 1 minute time frame, oh my god, it's as though your heart will be beating, like it controls your heart rate, because the spikes happen unexpectedly, and a lot of traders use this 1 minute time frame to trade. Well, me, I don't advise any trader to trade with the 1 minute time frame. A lot of traders use this 1 minute time frame to trade, but I don't advise any trader to trade with the 1 minute time frame. If you want to trade boom and crash, you should stop at a 5 minutes time frame. This is the 5 minutes time frame, and we also have the 15 minutes time frame. So this 15 minutes time frame is what I'm going to be using, and it's what I usually use for my trading. So anytime I trade with a 15 minutes time frame, and it is like the best time frame for every trader. If you want to really do something in the market, it is the 15 minutes time frame, because it helps you to get strong price movement in the market, at least reasonable strong price movement. There are some traders that want to trade with the 1 hour time frame, the 4 hours time frame, but all those big time frames, they don't really help you if you are starting out, especially with a small account like $30. So you don't need to go to the 1 hour time frame or start trading the 4 hours time frame. All those ones are not for you, because every little price movement on the 1 hour time frame or the 4 hour time frame is very, very, very volatile, and your small account cannot be able to survive it. So that's why you should trade with the 15 minutes time frame, and if you need to go lower, you should only go down to the 5 minutes time frame. That is the best that you could do. Don't go down to the 1 minute time frame. I don't advise trading with the 1 minute time frame. So the strategy that we are going to be trading with this asset is very simple. Let me show you guys the is very simple. Let me show you guys the first example, and I will be explaining how it works in the market so you can all grab it. So the first thing that we have to do is that we have to get a view of the trend. So like I told you guys, if you are trading with boom, your major focus should be on uptrending movements. It should always be on uptrends and uptrends. Forget about the downtrend, just focus on the uptrend for this strategy. I've already taught a strategy where you can trade with the uptrend and the downtrend, and you can make money trading the both trends. But this particular one that I want to teach you in this video, this one is only for the uptrend on boom, and when you go to crash, it is only for the downtrend on crash. Now there are two ways that we can trade this strategy. The first thing I said before is that you have to understand the trend movement. So if you check around this all these movements here, you can see that we are in an uptrend here. You see them, we are in an uptrend here. So it's very simple, guys. Look at the trends, look at it, we are in an uptrend. So with that knowledge of being in an uptrend, the first thing we have to do is to get the liquidity zone or the other block zone, anyone that you can call it. So there are two ways that we can do that. First, we can use the last candle, like this candle here. Let me draw something on it so it is simple. At this point here, you can see that at the point this candle that my line is on, this candle, this last candle here, this is a good area that we can expect our trades to come back to after breaking a structure like this one. And you should trade only strong structures, like structures that are very large and very visible in the market, so that you won't be able to be caught up on all those small price movement that won't give you more profit in the market. So like currently here now, you can see that we are using the same order block for our trade position where the market should return to before we can take a trade. Now when you have that already and you have drawn your line like this one here, you see, the next thing you want to do is to look out for an entry candle, and it is that entry candle that will not determine if you are going to trade the market or not. Now let me show you another example of this so you can understand what I mean by all these order block and liquidity zone, because there are like three of them that we use for this strategy. So on this example, you can see that let me place the focus here. So we are focused on this price movement here. See this price movement here, that's our focus. So when you see something like this, if you have been trading the market for some time, or let's say you have been understanding some things in the market, you know that the market starts with a three step. The trends, they start with the three step in the market. So the first thing they do is that you will see a structure like this one where the market will go up, then it will come down. Look at this, it will now come down to this point without breaking the last structure. So it will not break the last structure. Like as you can see here, the markets here, the price movements here did not break this structure, the last structure of the market. So we want to now see this, we want to see this price movement. Let me get this right. Okay, we need to see this price movement, then go to the top here, breaking this structure. So now it has broken this structure here. Look at the way it broke the structure at the top there. So because of that structure that it has broken, we are now looking out for a good liquidity strategy, a liquidity point that we can take our trade from. Now, if you look at this, you can see that before the market moved up, at this point here, before the market moved up, let me get this one right. Okay, before the market moved up, there was a little retracement here. And when you see this retracement here, you know that it is the driving power that will move the market to break that structure. That point, this little order block point here will no longer be valid for us to trade with. So we have now seen that the market has gone lower than that point, and the market has given us another liquidity zone here. So this liquidity zone here becomes our target point to take a trade. Now, to take a trade with this liquidity zone here, the main point is that we need the market to clear out that liquidity. So that point is now a potential liquidity point in the market that we can trade with and make profit from the market. So let's draw a line here and you'll see what I'm saying. Let's draw this line here at the low of that retracement. So now we have a line on the low of the retracement. Draw it properly. Okay, now we have it there. So we now have this point here. Look at it in the last view. We have this small point here, and now the market has returned to this our zone here. You see, the market returned to the zone. Let me use this. I want to take line spread to explain this. So the market returned to our zone, which is now the point where we can look out to take a trade. So when the market has returned to this point here, when the market has returned to this point here, we know that it is time to take a trade. This is our entry point, and this is the area that we want to take a trade from. Say if you wait for the market to always touch your zone before you trade, you are going to be making profit more than 60 to 80% of all traders, because you are now using a reasonable point in the market. You are not trading blindly in the market. You have a strategic goal to trade the market with. When you allow the price action to get to that zone where you want to trade the market from, that is what will solidify your trading strategy. It makes you disciplined. It helps you to wait for a point in the market before you trade. There are a lot of traders that they can just mark out a particular area in the market, and then now we're looking out for price action around that side. Then they start taking any entry they see without waiting for the market to get to their particular spot in the market. And the reason why a lot of traders do this is because sometimes the market will not get to your zone, but it will still move in your target direction. So let's imagine you want to buy a trade. The market will not move to your zone, but it will just hover around that little zone. It won't touch it, and it will now start moving to your target direction. This is the reason why a lot of traders, like, they grow this impatience in them. So anytime they see a little price movement and it is getting to that spot, they start to panic and they take anything that they see around that point in the market. So for you guys that are trading with this strategy, for you guys that are on this channel, synthetic trading channel, you are not going to be like them. You are going to wait for the market to get to your area, the area where you want to trade it from. And now I want to tell you something. The best entry signal for a boom and crash strategy is especially for this particular strategy is the engulfing candle. And I say this because it works the most for this strategy. I've tested this strategy like multiple times in the market, and I have tested with Pimba, I've tested with Doji, and a lot of all these entry signals. But the one that works the best for this strategy is an engulfing candle. And right here, right here, you can see that when the market touched here, it tried to form a pin bar. The pin bar did not work. Then it came down below it and it gave us an engulfing candle. So this engulfing candle is what you're going to use to trade the market. Once you see an engulfing candle, you know that it is time. It is time to trade the market. And the beautiful part about this strategy is that once you get your engulfing candle, your focus will not be on the target, which is this point here. You see my target, see the way the lines are, this crosshair line, that will be our target for take profits. They will now place our stop loss below it. But let me show you guys another example of this strategy at work on crash. So here we are on crash, and just like on boom, we try to follow the main direction of the market as we know it. Like if you are on crash, you're only looking out for downtrend movements. That should be your main focus on crash, because this is crash. I mean, don't look for uptrend movements on crash. Just stick to that price movement for this particular strategy. And like I said, I already have a strategy that you can use for both the uptrending and downtrending on crash and boom. But for this particular strategy, please focus on the main trend of the asset, which is exactly how they work in the market. So let me show you guys an example of our strategy on this crash. So here we have something like similar to what I just told you guys on boom 1000. And if you look at this price movements here, you can see that this is a fresh trend setup. When you look at this price movement here, you can see the market move down from this point to this point. Then after that, let me get this right. So after that, it moved up. You understand? It moved up to this point here and broke that area. So when it has done that, you know that you are still in an uptrend, right? But here's what happened. It came down again and broke this structure. So right here, the market came down and you can see that it broke this structure here. It broke this structure right here. So for breaking that structure, it has already automatically changed the trend. And because it has changed the trend, we are now looking out for our liquidity zone. So if you look at this point here, this area here. Now let me just bring this down here. Okay. We are not using these lines for anything, it's just for description. So if you look at this point here, this zone here, this is our liquidity zone. Because after this price movement, after this pay attention to the arrow, to the crosshair. After this price movement here, we had this bullish price, and which is followed up by a bearish one. And this thing is very important because since it formed at that point there, this is showing us that the buyers have some unfinished orders around that side. And when you see this, you know that sometimes when the market is moving down, it moves like purely down. It moves purely down, like you won't see any bullish candle here. But this bullish candle is like a trapped bullish candle there. And after this bullish candle, the candle gets moving down with strong volatility. So that is a good liquidity spot for us to trade the market. So what do? We place our line there, just the way I've showed you guys. So each time the market returns to that point again, like he did here, let me show you again. So the market returned to this point here. That's our liquidity zone there. It returned to it. And what do you see, guys? You can see an engulfing candle. So right here we have an engulfing candle. Look at it here. We have this engulfing candle here. So because of this engulfing candle, we can now take a trade and make money from the market. It is as simple as that. This strategy is very simple. Look at your chart and you will see it working almost every time in the market to give you at least a 90% win rate. No strategy has 100% win rate, but this one will give you at least 90% win rate on your trades because it works with a major trend of the asset. Now, if you want to trade this, for example, the smallest loss size for boom and crash is 0.2. You see that when I use 0.1, it didn't work. It's created a red, which means that you will not be able to trade it with a loss size. So now let's imagine that you took a trade from that point after that engulfing candle, and you now placed your stop loss above the engulfing candle. So on this trade, you'll be risking 1.80. So if you have a $30 account, that is like a very little risk for you. 1.80 to make $15.42. That's like crazy. It's crazy. Let's say you want to increase your appetite and put it on 0.4. That is 3.60 risk. You'll be making $30. That is your account. You're making your whole of your account in one trade. $3.60 in a very short time will be giving you $30 as profit. Let's imagine you now went ahead and this is 0.5, 4.50. You're making $38. Let's just say you risk $5, 0.5, 0.52. Okay, that's 9 now, 0.55. 4.95, let's just say, fair enough. You'll be using a 0.55 loss size, using a risk of 4.95, and you'll be making $42.39 on your trade. That is crazy, guys. This strategy is very, very powerful in the market. And this, if you don't know, this assets can only be found on Deriv, and that is the broker that we use for trading these assets, the only broker that provide all these assets. And I've provided a link for you guys in the description box below. If you are watching for the first time, go and get your account ready and fund your account and to start trading these synthetic indices. These indices are the best asset in the whole of the financial market. And we also have a VIP signal group where I drop all my trades. If you're interested in getting accurate signals in the market every single day, you can check the link in the description box below and join us in our VIP signal group, guys. So I will see you guys in the next video.